There's a number sitting on the XRP ledger right now that almost no one is reading correctly. It's not the price. It's not the market cap. It's not the daily volume. It's a number that has been quietly redrawing itself for the past 18 months, and by the time it finishes redrawing, the entire conversation about XRP scarcity will sound completely different than it does today. Most people walked into this market with the same assumption: 100 billion tokens, plenty to go around, end of conversation. But the people who actually read ledgers, the custodians, the market makers, the on-chain forensic teams, they stopped having that conversation a long time ago. Because somewhere between the ETF approvals, the tokenization infrastructure rollouts, and the quiet migration of institutional clearing onto the XRP ledger, the real supply question stopped being about the cap.
It started being about what fraction of that cap will still be reachable when the demand actually arrives. And the answer to that question is the part of the story that hasn't been priced in yet. Make sure to like and subscribe and drop a comment below with your opinion on XRP. And watch until the end. Welcome back. I am the calm analyst. Before we go under the surface, this is not financial advice. This is structural analysis. In this briefing, we examine why the math behind XRP supply has quietly become the most important variable in the entire thesis, and why every framework retail uses to dismiss it is built on the wrong starting number. Let's pull back the curtain. Let's start with the hard truth. 95% of people analyzing XRP supply are staring at the wrong figure. They see 100 billion. They calculate market cap. They walk away. But the 100 billion number is a theoretical ceiling, not a market reality.
It's the equivalent of looking at the total amount of gold ever mined and assuming all of it is available for trading tomorrow morning. It isn't. It never has been. And in XRP's case, the gap between theoretical supply and reachable supply is widening faster than at any point in the asset's history. Here's what is actually happening on the ledger right now. The circulating supply sits closer to 62 billion. The escrow holds the rest, releasing roughly 1 billion per month, most of which gets relocked. So already, the starting number for any honest supply analysis isn't 100 billion, it's 62 billion. That's the first correction. But 62 billion is also misleading, because circulating does not mean available. On-chain analysts at firms like Glassnode and CryptoQuant have been tracking a phenomenon that doesn't make headlines: a steady, measurable migration of XRP from exchange wallets into long-term custody addresses. These addresses don't trade. They don't rotate. They sit. Once a token enters a multi-sig institutional vault, it doesn't come back to the market for a 10% profit. It's gone for the cycle. This is what David Schwartz has hinted at repeatedly when he talks about XRP as settlement infrastructure rather than a speculative asset. Settlement infrastructure doesn't require speculation. It requires deployment. And deployed tokens behave very differently from speculative tokens. They lock, they route, they settle, and they exit the tradable float. So when you hear someone say, XRP has too much supply to ever appreciate meaningfully, what they're actually telling you is that they've never opened a custody report. They've never tracked exchange reserves. They've never read the institutional allocation filings. They're working from the sticker number on the box, not the contents inside it. Now layer this in. Ripple has spent the past 3 years building a stack: custody infrastructure, payment rails, RLUSD integration with G Treasury, prime brokerage through Hidden Road, that is purpose-built to absorb XRP into institutional pipelines. Every single component of that stack creates demand-side suction. And demand-side suction, applied to a fixed cap asset with shrinking liquid float, has exactly one mathematical outcome. That's the foundation. Now let's do the math. Here's the math the retail crowd ignores. There are approximately 7.4 million XRP wallets in existence today. If every one of those wallets held just over 8,300 XRP, the entire circulating supply of 62 billion would be fully accounted for. Every unit spoken for. Now scale that against where adoption is heading. Standard Chartered has projected $4 trillion in tokenized real-world assets by 2028. Ripple's own internal projections extend that to $19 trillion by 2033. Tokenized assets don't settle on goodwill. They settle on a ledger. And the ledger requires a native asset for fee burns, liquidity routing, and reserve mechanics. Let's do the math. If XRP captures just 1% of the projected $150 trillion annual cross-border payments market, that's $1.5 trillion in annual settlement volume flowing through an asset with a liquid float that's already shrinking. At a token price of 50 cents, moving $1 billion requires 2 billion XRP per transaction cycle. At $5, that same transfer requires 200 million. At $50, 20 million. The higher the price, the more efficient the settlement layer becomes, which means the system itself has a built-in incentive structure for price appreciation. This isn't a moonboy fantasy, it's a design requirement. Now layer in the burn mechanism. Every transaction on the XRP ledger destroys a small amount of XRP permanently. At current volumes, the burn is minimal. But the burn rate is a scale-sensitive mechanism. As transaction volume grows, and it will grow if tokenization unfolds at even a fraction of the projected pace, the burn becomes a structural deflationary force. It accelerates precisely when adoption accelerates. And the escrow. 1 billion released monthly, the vast majority relocked. That's not a supply unlock schedule. That's a controlled release valve designed to prevent float expansion, not enable it. Run the numbers together. Fixed cap, shrinking liquid float, accelerating burn, institutional custody absorbing supply from exchanges. Tokenization demand scaling into the trillions. If you have a problem with these numbers, you don't have a problem with me. You have a problem with the laws of supply and demand. This isn't a prediction, it's a requirement. Now let's talk about who is already acting on this thesis. Not who's tweeting about it, who's positioning on it. Hidden Road, which Ripple acquired, clears roughly $3 trillion annually across 300 institutional clients. That post-trade settlement activity is migrating onto the XRP ledger. That's not a press release. That's infrastructure being laid for an institutional pipeline that will absorb supply quietly, off the visible exchange order books. G Treasury, integrated with RLUSD, connects to 13,000 banks and processes $12.5 trillion in annual payment volume. XRP sits underneath that stack as the settlement asset. Ask yourself a brutal question. Does a piece of infrastructure plumbed into $12.5 trillion of payment flow get built around an asset the architects think is going to remain at current price levels? Absolutely not. They don't build at that scale around assets they expect to be irrelevant. BlackRock, Fidelity, Franklin Templeton. The same institutional names that pulled Bitcoin through its ETF cycle are now visible in XRP-adjacent filings, custody arrangements, and spot ETF flow data. The spot XRP ETF complex, in its early innings, has already absorbed close to 1% of total supply. And that's before institutional allocations have meaningfully scaled. This is the part that matters. While retail investors are complaining about sideways price action, the institutional signal has never been stronger. ETF flows have been net positive for an extended stretch of consecutive trading days. Custody address growth is climbing. Exchange reserves are trending toward multi-year lows. This isn't retail FOMO. This is calculated positioning by the same custodians, market makers, and sovereign-adjacent entities that have spent decades learning how to absorb supply before the rest of the market notices. They don't gamble. they position. And right now, the positioning data is screaming a story that the price chart is not yet telling. The smart money isn't waiting for the catalyst. The smart money is the catalyst, building itself quietly in the background while retail stares at red candles and wonders why nothing seems to be happening. Here is the sequence the market hasn't fully processed yet. The regulatory framework in the United States is approaching its final configuration. The Digital Asset Clarity Act, working its way through legislative process, is the final green light for institutional capital that has been waiting on the sidelines for definitive classification. Once that arrives, the risk premium that has kept allocators on the sidelines vanishes. The wait-and-see money becomes all-in money. Japan's FSA has already opened doors for XRP-based products that don't yet have full equivalents in Western markets. That's a parallel pipeline absorbing supply outside the U.S. regulatory bottleneck. Ripple has set internal milestones tied to its 2028 tokenization deployment targets. The custody infrastructure goes from operational to fully scaled within that window. RLUSD integration deepens across the G-Treasury network during the same period. Every milestone in that timeline is a supply-absorbing event. And then there is the macro layer. Central bank liquidity cycles, reserve currency restructuring discussions at the IMF level, and the broader institutional reallocation toward digital settlement assets are all converging into the same window. The fuse is lit. The countdown has begun. Once these catalysts arrive, there is no going back to the pricing structure that exists today. We are moving from an era of abundance to an era of scarcity, and the transition is faster than the market believes. Exchange reserves are trending toward levels not seen since the early years of the asset. Institutional custody addresses are growing month over month. ETF vehicles are absorbing supply into structures that will not release it back to retail markets in any meaningful time frame. Treasury companies, following the playbook Bitcoin treasury companies wrote, are beginning to build XRP positions designed for permanent balance sheet allocation, not trading. Here is the uncomfortable reality. Once a token enters a multi-sig institutional vault, it does not come back to the market for a 10% profit. It does not come back for 50%. It often does not come back at all during the cycle. That supply is gone from the float, and every additional institutional position compounds the effect. The institutions have spent years trying to shake out weak hands so they could take the position. That's what the sideways price action has been. That's what the FUD cycles have been. That's what the regulatory uncertainty served. Psychological warfare designed to convert long-term supply into short-term selling, so the architects could quietly accumulate at prices that will look absurd in retrospect. The door is closing fast, not because of hype, because of mechanics. The window during which whole tokens are accessible at current price levels is finite, and the entities closing it are not waiting for retail consensus to form. I know it is difficult to hold conviction during a period when the price chart tells you nothing is happening. I understand the frustration. I see the same red candles. I read the same skeptical headlines. But as an analyst, my job is to distinguish between noise and signal. And the signal right now is structural, not emotional. The red candles are a smokescreen. The boredom is the calm before the systemic reset. The silence in the price action is the silence of a predator waiting to strike, not the silence of an asset losing relevance. While the masses are focused on short-term volatility, the smart money is absorbing supply that will not be available again at these prices. Being early feels exactly like being wrong, right up until the moment reality catches up. And reality, in supply-constrained systems, catches up quickly when it catches up at all. The question isn't whether the supply mechanics will eventually express themselves in price. The math guarantees they will. The question is, who will still be holding when that expression happens, and who will have sold their position to the institutions during the phase that felt the most pointless? Make sure to like and subscribe, and drop a comment below with your opinion on XRP, and watch until the end. So here is what the math actually says. 62 billion in circulation, not 100 billion. 5 separate mechanisms: ETF absorption, institutional DeFi custody, treasury company accumulation, ledger reserve growth, and transaction burn, all draining the float in parallel. A demand pipeline being built across $12.5 trillion of bank payment infrastructure. A tokenization wave projected to reach $4 trillion by 2028 and $19 trillion by 2033. And a regulatory framework approaching final clarity within the same window. The supply shock isn't a question of if, it is a question of when these forces reach critical mass simultaneously. And based on the data, that convergence is arriving sooner than the current price action implies. Price is a distraction. Structure is the reality. The investors who understand this aren't refreshing charts. They're reading ledgers, tracking custody flows, and letting the math do the heavy lifting. If you made it to the end of this briefing, drop the word reachable in the comments. I want to see who actually understands the difference between total supply and available float, because that distinction is the entire thesis. Stay analytical, stay patient. The math doesn't lie, and the system is almost complete. I am the calm analyst. I'll see you in the next briefing.